Hello everyone, and welcome to today's interesting and topical discussion about the impact of COVID-19 on the real estate sector. My name is Reka Tura, and I'll be the moderator for today's panel discussion. So by way of background, I've been in real estate since 2007, with a focus on commercial investments in the UK and Europe. My most recent role was as Chief Investment Officer of a European hotel chain backed by Cerberus. I'll shortly introduce you to our fantastic panel, but before I do, I just want to make a few points to set the context. So lockdown began in March, and today only 1/3 of the workforce have returned to the office in the UK. Obviously, with the news from this morning, that number is going to go down, and we don't really know what the future holds. Businesses owe landlords millions in unpaid rent. The knock-on impact of working from home and travel restrictions continue to have a catastrophic effect on hospitality and retail. And the UK is officially in recession. The economy shrank by a record 20% in the June quarter. Global transaction volumes are down 29% for the first half of this year. And on top of that, we have the challenge of further lockdowns and the Brexit deadline of 31st December fast approaching. We've never seen such a big shock to real estate in such a short period of time. So what does it all mean, and what does it mean for the future? I'm delighted to be joined by a panel of experts who will help us wade through a variety of topics, including the impact on asset classes, the impact on investor and lender appetite, and also what opportunity the pandemic might present for the real estate sector. I'd now like to introduce our panel. So firstly, we have Amiga Paul, who's a partner in the real estate group at law firm Mishkon Nerea, and she's also the head of the debt advisory practice. We have Valentina Shigoyan, who's the managing partner at Reach UK, and that's a strategic technology investment fund backed by the National Association of Realtors. Valentina works quite closely with property tech startups launching into UK real estate. And then we have Ilyana Divka, who's a director in the advisory arm of CBRE, a large global real estate services provider. He advises institutional investors and leads investments into funds. And then last but not least, we've got Ruslan Shopov, who's an associate banker in the real estate investment team at the European Bank for Reconstruction and Development. He covers debt and equity investments with a focus on Central Eastern Europe. So just some brief housekeeping. We've got a lot of content to get through, and we'll try our best to get through as much as we can. Thank you very much for submitting your questions in advance of the session. I'll also keep an eye on the Q&A function that you can submit questions through live. I'll keep an eye on it, but we'll see if we can answer some of those questions. And then at the end of the discussion, Fabio Pasquale, who's the association's treasurer, is going to say a few words about the INSEAD Community Impact Challenge. So before we start, we're just going to do a quick poll, just so we understand who our audience is today. So we have 72 people in attendance, and I'm launching the poll now just to understand what business sector you belong to. So the options are real estate, financial services, consulting, and other. Just waiting for the numbers to go up. 62%. Okay, that's interesting. So 28% real estate, 44% financial services, 17% consulting, and 11% other. Okay, so it's a bit of a mix, and actually it's not majority real estate. Sorry, I didn't share the results. So here are the results. Okay, so let's get started. First question about offices. So what do you think the future of offices will look like? How do you see the appetite for space changing? And do you think the phenomenon for working from home is here to stay? Who wants to take that question?
I'm happy to kick off, Reka, on that one. I know we've got quite varied views across the panel, actually, and I'm in the office today. I've been trying to come back in a lot more recently. My personal view is we're going to end up with much more of a hybrid of working from home and coming into the office. We've certainly seen everybody become much more adaptable to working from home, but also, in my view, seen some disadvantages. So, for example, it's much harder to train young people. It's harder to have sort of ad hoc sharing of ideas, face-to-face interactions with clients. There's a great amount you can do in forums like this, but also nothing quite beats that personal, in my view, interaction of seeing people in the flesh. And I think there are also potentially mental health benefits of coming into the office, separation of work from family life, the physical suitability of the space around us, and also perhaps our own kind of physical movement. And I think we will move to a more hybrid solution. We're seeing in terms of existing occupancy that tenants are extending their leases with landlords, but looking for much more flexibility. So they're extending them, looking for shorter term leases, and also having options to change the square footage that they rent. So my view is that offices and also retail are going to move much more, or a bigger proportion of the asset class is going to move towards a more operational style tenancy arrangement. We've also seen actually in the finance space an appetite for offices. So it's not that this asset class has become completely defunct. We've seen, for example, Allianz have just written a ticket of about 400 million to Lazari Investment for 5 prime offices. It's fairly modest leverage of 50 to 60%, and there's a huge range of tenants in there. But they obviously still have appetite for office finance. And similarly, ICG wrote a ticket of about 90 million. So lenders still have appetite for office. I don't think office as an asset class is going to die out, but my view is it's certainly going to change, and we may see more of a nuance, a diversity of different types of office offering going forward.
And Ruslan, what's your view from a Central Eastern Europe perspective?
Yes, I may continue on this topic. So in my view, the office sector may be the long-term casualty of the COVID pandemic, as many companies are likely to adopt more working from home, as Umiga already mentioned, and the net effect would be negative for office demand. But the question is to what extent? It may be marginal or it can be significant. So the COVID pandemic accelerated, let's say, pre-existing trends for retail and logistics, which we'll talk about later. But for offices, I think it forced like a mass home working experiment, which is likely to continue after the pandemic is over to a certain degree. So since the relaxation of the lockdown measures, most companies have adopted a hybrid approach by partially working from home. Minority of companies have fully returned to the office, and some others are actually entirely still working from home. For instance, in the Central Eastern European region, and Poland in particular was the most developed market there, about 20 to 30% of the workforce has returned to the office already. What I also observe on the market is a significant slowdown in leasing activity, and therefore more difficult to fill vacant space at the moment. Rent renegotiations are commonly in the form of, let's say, rent-free periods and the exchange for equivalent in duration lease extensions. There is another interesting trend, which is subleasing, and I call it like a hidden vacancy because it's currently not really reflecting the statistics, but fundamentally this also represents decrease in demand. Also, there is a market slowdown in investment market, especially in regional cities across Central and Eastern Europe. Of course, deals are still closed, but there are some slight discounts which we already observe in the market, and we can talk about later about transactions. But for now, I think that the hybrid mode will be probably the long-term consequence of the pandemic, and that's why I think the most interesting question is exactly about offices going forward.
Yeah, very interesting, and it's quite a big trend now for flexible leases, and tenants are looking for shorter terms. What do you think that means from a valuation perspective? Because obviously those days of having long, 15 to 20 year leases with no breaks, maybe the lease terms are going to come down. So how do you think that's going to impact yields?
Yes, well, obviously, if this trend really materializes, then the yield should reflect the fundamental market risk, and then obviously the market risk will be higher. So in Central Eastern Europe, usually the office leases are actually shorter. So maybe the most common lease term is like 5, let's say, to 10 years. So it's still usually shorter than the UK. But yes, maybe you're right that actually we'll start observing companies demanding shorter lease terms from now on. And let's see. So I think it's too early days to draw definitive conclusions.
An interesting trend that Omega has already touched upon, that world is moving towards flexible working space arrangements. And sometimes, quite often, we can see that real estate owners they start operating certain parts of their real estate holdings as flexible office space themselves. They even no longer need an operator to do so, because there are a number of solutions in the PropTech world that cater to that market. And if you look at the proportion of those leases versus the normal long-term lease, what statistics shows is that in the nearest future, it looks like that's going to be 8.5% of total office space operated under the flexible working arrangement. It may sound low, but if you look at e-commerce share of total retail, it's also around like same percentage, same number. And look what e-commerce has done to high street retail. So I would say that it's actually a large proportion. Now, when it comes to valuations, it is difficult to evaluate those 8.5% on a cap rate basis. And some researcher suggest, and investors start adopting that gradually, looking towards that direction, that office space can start being valued as a multiple of EBITDA that desk produces. Again, don't take me wrong, I'm not talking about 100% of offices. I'm talking about that like up to 10% share of total office space that can move into this direction. And we can think of that portion of offices, start looking at it as we normally look at hospitality sector, where we separate real estate and operations. So that's a curious trend, generally speaking. Another trend that I can pick up that has been a function of COVID somewhat is the focus on wellness from the landlords, operators, tenants as well. Wellness of the ultimate occupier. This trend is not new, so it somewhat was already there pre-COVID, but COVID clearly accelerated the focus on it. Now a lot of landlords and tenants are looking for solutions that help with air quality issues, that help to address the need for the touchless solutions. Those are somewhat new things. Then anything like real estate also becoming an industry that is moving from serving the tenant to serving the ultimate occupier, which is an employee of the tenant. So there is a lot of focus now on the experience, comfort, and mental well-being of the ultimate occupier. And then it's not really, like when it comes to the investor and landlord, statistics shows that the landlords that provide, that do well on the well-being measures, that they command more than quarter higher effective net rent on their buildings. So that's not bad. And then ultimately, when you think from the tenant perspective, them investing slightly more into real estate that helps their workforce to be more productive makes perfect sense when you look at their P&L. So on average, real estate only takes about 9% of total cost of like average corporate, and payroll is 90%. So definitely, if landlords become more focused on the well-being of the ultimate occupier, they can they can certainly command higher rental rates. And that also goes all the way down to ESG topic, which is now extremely like been in focus for quite some time, again pre-COVID, and COVID put quite a bit of focus on the discussion. So if you think about their how effective the building, how much more efficient the building can be from the energy consumption point by utilizing again certain tech tools, then net it's a win game for the landlord, because yes, it is more expensive to run sustainable building, green building, but you can ultimately command higher rental rates because you have some certain savings on your outflows on the energy consumptions, and then ultimately that gets capitalized through the cap rate into the ultimate value of the building. So all of those trends, I have to say, that probably existed, some of them slightly new, but ultimately most of them were accelerated with COVID.
One, just to pick up on the ESG point, a very a small but interesting, slightly counterintuitive piece that we've seen in industry surveys recently. And I'm a big proponent of focusing more on sustainability of buildings. And I certainly think from wellness, there's been a groundswell, and the occupier is now starting to demand or expecting perhaps better space to be delivered. When we look at actually ESGs as a slightly separate subject, recently there's been a survey around by CMS and reported in Property Week suggesting that 77% of investors, so the capital, now look at ESG very closely and think it's incredibly important, but actually only 42% of occupiers have it as a very important priority in terms of the buildings. So whereas I would like to believe that occupiers are also going to start driving the ESG agenda as well as the wellness agenda, actually recent feedback in the market seems to suggest it's the capital and the money that's focused on ESG, and perhaps not so much at the moment on the occupier side. And just very quickly, I saw a question pop up around the London office market. And so historically, average leases in London office have been about 10 years, which is obviously quite different from, say, the 3 years or so that you might see in somewhere like Madrid. I think that was a question I thought I'd quickly cover off.
Yeah, so I want to jump in here on the wellness topic, Omega, and as much as the investor side is keen to show these ESG certificates and try to sell them at a premium, both to occupiers and to whoever the buyer is, if they're the vendor, the crude reality is that we're in the middle of downturn and a pretty steep one. So the majority of landlords in the end of the day will have a hard time selling extra space, especially when you think about wellness in the context of additional amenities, a lot of space per employee, etc., etc. Landlords will have a hard time to put a price tag to that and drive rents through that kind of initiatives, because occupiers will be tightening their purses. So you see probably the tech sector is the leader in that space where they really have the money to spend on these extras, but you probably see it in a few other very high value add industries, but very likely the majority of corporate occupiers will actually struggle to add this to their bill. As employees in a service economy, employees is cost number one. Offices, your office space is your cost number two as a business usually. So I expect actually the trend, especially on the wellness topic, to take a back seat, with the exception, of course, of minimum requirements around your air conditioning systems and air purifying systems, and the necessary sanitation and cleaning services to disinfect spaces and surfaces.
And is it the case that, you know, if you're investing more in sustainable buildings, they are more efficient, they last longer, we would expect them to fetch higher valuations?
Not necessarily, really. What we've seen is a discount rather than a premium. So if you're below a BREEAM excellent or very good at least, You're starting to see that buildings struggle in their marketing effort, especially in the larger lot sizes where you're reaching to institutional investors who've established minimum requirement criteria for their ESG policies.
Mm.
But a strong premium is, you see, it's a very difficult number to pin. You see some estimates, but a strong premium is definitely not the norm.
When it comes to ESG, in the context of building, you talk about A, energy efficiency immediately, B, air quality. At the very least. So energy efficiency, if you, like when I talk to the guys in innovations teams of large asset managers, they say internally, those are the easiest tools for them to sell because that immediately hits their bottom line. Because if you are energy efficient, then it materializes immediately through the savings on your energy bill. Brilliant. And then again, it can be capitalized. So to answer your question directly, yes, of course, there is an uplift. Naturally through the cap rate, it's the same cap rate. So effectively, as Eliana says, there is no real premium to be charged. You just have higher net rental income, that's all, which is helpful. Then the air quality, that just becomes a necessity now, because if you cannot provide that, then the building is not safe, people cannot return. And then ultimately in the long term, the way I see that unfolding, as Ruslan said, we are living through the biggest experiment of our lives. And people, they develop habits. And now, if I, as an ultimate employee, I tried to work from home for a year and I like it, I start valuing certain things like the quality of air, the proximity to certain places, not being distant from family, from retail, from hospitality, from the places where I used to go out. So ultimately their landlord and their employer is prepared to offer that as a benefit to their employees, because employers have been living through the same experiment, seeing that some of their workforce are not less productive and in some cases even more productive working remotely. Then for the landlord to bring back the occupancy level to what it used to be pre-pandemic, and then that ultimately also is reflected in valuation, because your valuation is a function of your occupancy. Then unfortunately or fortunately, we'll have to offer certain things which fall under ESG category, but not because they just naturally like to be green, but that's because they're forced now to focus more on the well-being of the employee, to make sure that this employee tells to their employer that I actually want to work from the office because it's more convenient for me, and then the employer decides to hire extra space. And to address the point on the number of square meters per employee, now naturally that's going to increase, again, because it's a necessity, because of COVID. And also because people find it a little bit more comfortable to work when there is more space and they're more likely to demand going back. So ultimately now we are moving, like up until recently or just before COVID, their offices were moving into the direction where we are trying to put as many desks into a given number of square meters as possible, and that was totally sellable to the ultimate tenant. Now this trend definitely reversed. So that's not about how many desks you can put into their office, rather how many employees ultimately you can convince to go back to the office. So this basically this experiment triggered certain change in habits, and those are long-term things. That's a long-term phenomenon.
Yes, maybe just to add on my side that for institutional investors like the European Bank, it's extremely important that the buildings in which we invest are energy efficient, and we insist that these buildings should be BREEAM or LEED certified at a high level. And we also believe that this should add value to the long-term valuation of these buildings. And of course, they should contribute to the energy savings during their operational lifetime.
You just went on mute. Yeah, it's such an interesting topic, especially at the moment, and I think there will be a lot more change to come. So just moving on to the topic of logistics, in the midst of all of this, it seems to be a key beneficiary. What do you think the demand for logistics looks like, and do you continue to see an upward trajectory of growth?
Yes, so logistics is definitely the biggest beneficiary of the pandemic. Sorry, was the question to me first, or? Or maybe I can. Yeah, so in my view, obviously the logistics sector is the biggest beneficiary of the pandemic, mostly because just the e-commerce growth was accelerated. So in Central Eastern Europe, this is now the most liquid market. And for instance, in Poland, in the first half of 2020, there was a record-breaking 2.2 square meters of gross take-up, which is actually the second best result in Europe overall, and amounts to an increase of 30%. In terms of development, the market is also very active. And again, in Poland, around 1 million square meters were completed in the first half of 2020, with Poland again being the third most active country in Europe. Of course, there may be some questions to potential oversupply, but this is partially mitigated by the fact that there are strong pre-leasing requirements, which are of course imposed not only by the lending institutions, but sometimes even by the investors. So for more developed markets in C, like Poland, the pre-leasing requirement is about 30 to 40%, while in Hungary and Romania, for instance, it's about 50%.
And yeah, so logistics looks like a winner of the current times. They've already seen their acceleration in demand due to their transition of retail from high street to online, and now with COVID even more so. But what I would encourage you to think is, what is their ideal logistics asset warehouse of the future looks like? And that is not necessarily their majority of the warehouses that are in operations today. So that's why logistics owners can struggle a little unless they're a little bit more forward thinking. So what happens in logistics space right now with COVID as well, so there is a trend towards automation, and a lot of robotics solutions have been placed into logistics centers, A, to increase efficiency, B, in the COVID environment, people have preference for their goods to be packaged by robots. So I know people personally who have preference for their delivery services that they know for sure use robots in their and automated facility management in their warehouses. So that's one. Second one, when I speak to real estate, to logistics or owners of warehouse space, what they now provide to their tenants. So they say that their product that used to be just 4 walls on the roof, it remains the product of the past. Now, another dimension they have to add and provide to their tenants is the data around where the certain bit of what ultimate tenant owns is stored in the building, how to get that, what is their ultimately delivery item delivery tracking solutions. And that is all becoming possible with 5G that's now entering the space, and with Internet of Things solutions. So all of that is also in the demand. So the logistics centers of the future are being additionally ask for this additional piece of service. And all of that will be increasing the energy consumption as well. So now, if you think of the right space to build your warehouse, you need to think about not only the energy that comes to the site from the outside, but also what energy unit you can build within the building, because all this robotics, 5G is extremely energy consuming, and we need to factor that into your new development. Or so basically, there is a high chance that a large portion of warehouses of today will become obsolete in the very nearest future, when we have all those new tech available and being built into the warehouse facilities. So I hope I don't sound too much as a millennial on that panel, but yeah.
Well, it'd be useful to, I guess, from an occupier perspective, if that's what they're looking for now, the real high-tech warehouses, demand, is there going to be a shortfall for a long period to come? Because as we know, the real estate sector is quite slow moving.
That's an interesting question, but at the same time, look at how many spaces are becoming vacant at the moment. So let's see a lot of it's very extremely topical now to talk about repurposing retail. We will be seeing repurposing of some office space as well, just as we discussed now. Some of that office space won't be required as much, and we will be seeing new development coming as well.
Yeah, on the topic of retail, so obviously, as we're saying, it continues to suffer in the backdrop of all the explosion in online. What opportunities do you see in retail? So you mentioned the repurposing, but there'll be a lot of retail stock which might not be suitable for that, or do you see that is going to happen quite a lot, the redevelopment?
Well, distressed, I would say. Although the workout market and the distressed funds are not yet there. Pricing is not there yet, but pretty much everyone expects the sector to go through a proper purge. Just a simple stat. I think it was at the beginning of the year when we got our valuation statistics on the UK shopping center market, and on a year when I think the average market, excluding retail, got a capital value uplift of 2 to 3%. Not a single shopping center got a positive appraisal. So no one realized any capital growth, and the discounts in some cases for the secondary stock and the more regional stock were very heavy. And retail at the moment, the one section of the market that attracts interest and continues to see investment flow is the long income assets. So these are convenience-led, index-linked long leases on the Tesco's and the likes, and this is led more by the downturn point where a lot of people are looking for income security, and long income seems to be a safe bet, but the rest of the market needs a bit more time to actually lose more value before it becomes feasible for the distressed entries.
I mean, the leasing space in retail is really quite interesting. So other than the long-term income strip type assets that Ileana is referring to, the Tesco's and the like, we, as you might expect, leases on other retail are getting shorter and shorter, and we're also seeing much more of a move, as I mentioned, for office towards more operational style turnover leases. And so, for example, New Look, which has a portfolio of about 500 assets, I think, recently negotiated to have 402 of those moved over to a turnover basis. We've also seen some really interesting anecdotal feedback, which I think of when I'm advising from a lender perspective in terms of the underlying strength of the covenant. So there's feedback that in portfolios, we're seeing some of the the sort of mum and pop type shops, the retail, those type of retail really trying to make their rental payments. And on the flip side, those covenants which historically would have been considered very strong, so some of the big names, actually using their negotiating clout, and potentially the fact that there's obviously a moratorium against enforcement in the commercial real estate space that's now been extended to the end of the year, might be sort of encouraging, if you like, sort of bad behavior, actually looking to not really enter into negotiations with their landlord, but simply tell their landlord, this is the discounted rent I'm planning on paying you. And so from a lender perspective, there are a number of challenges. First of all, lenders will more and more across lots of asset classes, I think, have to get used to underwriting operational type leases. And so we're already seeing lenders really dig down into the covenant and want to speak to tenants to understand what their businesses are. They may have a slightly different view on tenants, which in the past might have been considered slightly weaker covenants. And also I've heard lenders talk about creating a sort of almost a blacklist of those tenants which they think are behaving badly. So tenants who one day are announcing profit results and then the next day are writing to their landlords and saying we're going to give you discounted rent. So lenders are looking at how they can overlay these more subjective criteria onto their underwriting models. So there are all sorts of interesting trends going in the retail market that probably have just been, because we've seen the uptick on online sales way before COVID, but have really been accelerated by this crisis.
Yes, maybe on my side, I just want to highlight that there is an interesting, difference between the retail sector, especially the shopping mall sector in Eastern Europe, in Central Eastern Europe and Western Europe, because in the CE region, the shopping malls are much more dominant, mostly because the high streets are simply quite weak, and that's why the shopping centers are much more dominant in our region. Therefore, after the shopping malls reopened, let's say in early May this year, they have managed to recover around 75–80% of their footfall and even more their turnover. So their turnover is almost like 90% recovered already due to higher spending per visit. Nevertheless, even though the operational performance of the shopping centers is better, investor interest is rock bottom, and as one investor put it, retail is probably not dead, but not dead yet. So that's why the valuations are, I think, going forward, especially on the capital markets, are heavily impacted, despite the better operational performance.
Okay. And just moving on to the subject of development, how do you see it being impacted in the short term and then also into the long term?
So I think development is quite an interesting space. So just thinking about it from a financing perspective, it's been one of the most sort of buoyant parts of the finance market. Obviously, the finance market has been relatively muted. We talked about transaction volumes already, and overall leverage appetite has gone down and pricing has gone up. Probably no surprises there. But for specific asset classes, development financing is still, there's still appetite there, and specifically residential is one of the areas that we're seeing a lot of development finance appetite. In the UK, at least, there still remains a sort of a strong, a stark imbalance between supply and demand when it comes to residential. And it's also sort of seen as, one lender described it to me as one of the kind of the green asset classes. So whereas retail and hospitality may be considered not dead yet, as Ruslan said, or sort of red, and offices amber because nobody really knows what's going to happen. Residential and logistics certainly seem to be considered more kind of green spaces. And conversely, we've also seen in hospitality, which as an investment class has been hugely impacted, as you would know, Reka, from your hospitality experience. We're still seeing development financing, and I think that's partly because once lenders can mitigate and manage risk around supply chain, potentially lack of skilled workforce and other lockdown type risks, they see development as something that is going to come into the market in, say, 2 years' time, when hopefully things will be back on a bit more of an even keel. So we've seen, for example, a big hotel financing that Shiva secured about 230 million from Kale Street and Castle Lake for a hotel development. Now, obviously, hotel as an asset class is facing lots of challenges, but the development space, interestingly, lenders are looking at a longer term outlook there.
And another interesting trend when it comes to development, future developments, future like best use for the land plots, it seems like the interest increases again from the developer side for mixed-use developments. So that's where you can bring together in the same area real estate that includes offices, residential, retail, hospitality, simply because, again, now people are less used to commuting, and probably that will remain in place for a few more, for the long term. And mixed-use developments is the solution. So indeed, people do want to go to the office, but they want to go to the office on demand, and they do want the office to be in a close proximity to where they live. So that's another trend that's now accelerating. When it comes to development itself, so as we all know, development.
So Valentina,
yeah.
Do you see flexible offices now being incorporated into these mixed-use schemes even more?
Yes, for sure. And an example that I could immediately use there, like if you look at WeWork has central locations and has more like regional presence, or like offices in Zone 2, Zone 3 in London. And when I talk to the operators, I gather that their occupancy of non-central locations has increased versus their central or like the locations within the office hubs, simply because people do go to the office, so they do like the office environment, but they want to go to the office that's walking distance from their home, and with WeWork they can afford that. So that's exactly the trend that is probably going to stay there, and large office operators, they would also then, or landlords, they would also then to look to develop within their mixed use development scheme an office component. It's not necessarily flexible, so you can still have long leases there, but it's just the point is that it will be closer to people's homes.
Mm-hmm. And just on development, Amiga, as you were saying, for hotels, the opportunity cost right now for development is low because we know that the hotels are not performing. There's more closures to come. And if the deal stacks up, it makes sense to proceed with it, because we've seen over the years there's been a lot of speculative pipeline which may not come to market. And now it's a question of being really sure that, you know, this location and this type of concept is going to work, and to be quite selective of those developments. And lenders will also be scrutinizing that.
I think that's
people will start.
I think that's absolutely, I was just saying, I think that's absolutely right. Obviously, some hotel operators have taken the lockdown opportunity to do CapEx work that has been on their kind of books to do for some time. And maybe if we think about not just the development side, but actually current hotels and how they're impacted in the market, the feedback that we get from brands and valuers is that they see the COVID trend playing out much like other crises. So occupancy may take 3.5 years to come back to 2019 levels. Average rates and RevPAR and EBITDA may take four years plus to come back to pre-COVID levels. And there's also a discussion around sort of pricing correction in the hospitality space. And this is obviously very broad brush because every asset is different. But there's some discussion, you know, best case scenarios, maybe 5%, worst case scenarios, 30%. So most people seem to think that it's going to be somewhere in the 10 to 20% sort of price correction region for existing investment assets. So obviously, if you're looking at developments, you have to consider the overall, as you're just suggesting, have to consider the overall market that you're planning to deliver that asset into.
Yeah, absolutely. And it's also that, yeah, exactly what you're saying. It's a segment of the market as well. So during this whole pandemic, we've seen that economy budget hotels tend to be performing better than the luxury end. And the reason is they tend to have a lower staffing level. They are more profitable, generally speaking, better in a downturn. So it just requires a lot of scrutiny of what that particular development is. And then just as we were saying, so in terms of sectors which are reliant on travel, we've got hospitality, and then we've also got student accommodation. Does anyone have any observations about what they're seeing in for example, student accommodation?
So student accommodation is foreign student-led. That's why we're mentioning it in the context of travel restrictions. And a lot of people probably don't realize, but the UK's education system is a massive export product. And this means that probably, I wouldn't say, I don't know if it's the majority, but a very significant minority of students are foreign who come to the country and very often choose to stay in developed institutional student accommodation assets for convenience and safety and security, etc. Now, the interesting thing, and this is a lot in the press in the US as well, the interesting thing is actually that student accommodation trade has two secular trends. So one of them is obviously what's going on with the current student year, but then the second one is that long term, everyone expects this trend of internationalization of education to continue, and it's supported by wealth creation in Asia specifically, across Asia, massive markets. Our Chinese students, for example, are expected to rise from 10% of the current UK population to 20% in the next few years, and this growth pushes through. So deals continue to be priced actually at a similar level to where they were at the end of last year, and with the only difference that basically investors expect a rental guarantee for the current academic year. So they're bridging the gap of just expecting 1 year of poor income and pushing into the next one it's similar appraisal levels. The big when the pandemic started and everyone started panicking about student numbers coming down, actually Blackstone pushed through with the largest transaction I think in UK real estate history when they acquired the platform, and it remains to be seen, but the long-term trend of this trend supporting the sector actually very positive. So it's a matter of a year or two to clear.
And certainly the clients that we speak to say they've seen a switch in, so occupancy levels have remained broadly the same, so many cases over 90%, actually, yeah. But they've seen, whereas before it might have been say 55% overseas students and 45% domestic, now that's turning round. And I think the UK Universities and Colleges Admission Service have reported recently a stat that there's roughly 13% fewer EU students coming to the UK at the moment, although non-EU countries students have gone up 2%. But obviously you have to balance that with the fact that if we sadly see more unemployment, then we may also see more people going back to universities as they look to reskill and go back to academia. So I agree with Ileana. I think that this is going to be more of a short-term issue in the student space, and generally we're seeing occupancy has still remain fairly robust and assets still trading at similar prices as they were before.
And the trend for, doing online courses, do you think that's a short-term one? Because ultimately people want to be face-to-face and in classrooms and lectures.
Oh, everyone started hating Zoom after a few weeks on the platform. So probably we can extend this to online courses. No, apart from the joke, apart from silly jokes, education generally charges significant premiums when universities are able to sell their brand, which is created normally in the local market with face-to-face standard plain vanilla programs, and sell professional certifications and all kinds of off-site education programs. It's the cream on their profit margins. So you would expect this trend to continue, but would this really lead to people choosing to do entire degrees in this context, losing the student experience?
So I think that universities are going to have to really justify the premium in terms of pricing. So obviously there's some great online universities that have been around for decades, like the Open University is a really good example, and the fee difference between somewhere like the Open University and an online course from a mainstream university is quite big. So I think universities are going to have to really justify the premium that they're charging compared to some fantastic courses people can get online, and that will have to be around the experiences that they offer students.
Absolutely. And then moving on to, how do you think occupiers have prepared for Brexit and the withdrawal of government support measures?
The can of worms, the $1 million question, call it whatever you like. Brexit is still a very undefined outcome, especially in the short term for the UK. what we've seen, so everyone expected that a lot of occupiers, especially finance, professional services, so London-based occupiers would be making decisions to decentralize their European presence, and there was a lot of speculation about is it Frankfurt, is it Paris, is it Amsterdam, is it Dublin winning business from London? But then early Brexit estimates were that London would lose up to 10,000 jobs in finance due to Brexit, and current numbers to date stand at 2,000. So we're seeing mild effects. We're seeing continuing confidence of occupiers through new leases being signed over the last few years, significant leases, large commitments, and investor demand continues to plow through. So we haven't seen it, we don't know yet, basically, short answer.
If I may take a question from the chat on PropTech and residential space, and I think we also had an earlier question on residential market and how pandemic affects it. PropTech can solve a lot of, is trying to address a lot of issues within real estate, but I think one of the fundamental issues that real estate has, and that's why it's such a slow industry, that's why it's often referred as a kind of private old man's club, is the lack of data. What is also holding PropTech back and applying all those nice ML AI algorithms to decide on the perfect value of any property is, again, the lack of data of the underlying property, what's inside, what's outside. And that is something that is also ultimately has been accelerated by pandemic, because by working from home, all of us started printing less, signing fewer documents with ink on paper. We do a lot digitally, and that's something what a lot are missing at the moment. So that creates an enormous foundation for PropTech solutions of the future. So now everything goes online, everything no longer printed and stored in a separate room as it used to be in real estate up until recently. And that will trigger a better liquidity ultimately on the market. And that's where deploying institutional capital, so it will become an enabler for deploying any capital, quite frankly, international capital, institutional capital, cross-border. But wait for it for a few more years, because now when people are talking to me about like iBuyers, AVMs, all those nice techie things, I say, well, listen, let's start with data first. And there are a lot of PropTech solutions that all they do, they gather data for you and bring it in a digestible format that you can ultimately run through your spreadsheets and analyze yourself for the time being. Now, the next level will be algorithms that analyze this data for you. And that comes to the investment side of business. Then it also touches property management side of business, asset management, when you ultimately can have a dashboard that summarizes what's happening in your property right now, but does it for you remotely on the basis of some digital twin BIM enabled. So that's what PropTech can do for you. But first, data gathering, and this pandemic helps this data gathering exercise enormously.
Mm-hmm. Okay, and then moving on to the topic of deals. Do you see deals being repriced? Do you think transactions are taking longer to get done? And where do you think investor appetite is still strong? Amiga and Ruslan?
So if I deal with this, because I know we're running out of time, so I'll deal with this quite quickly. I think it really boils down to the traffic light system that it's very broad brush, but that I was talking about. So obviously assets that are logistics supermarkets, there's still a lot of appetite. Hotels and retail, big question marks, and offices are somewhere in the middle. We have seen changes in sentiment in the market. So for example, the CREFC recent survey at the end of Q2 supported that. So people were significantly pessimistic about retail and hospitality, and actually also student, modestly pessimistic about office. and multifamily alternatives and industrial were sort of considered okay. We have seen huge activity in the shed space that Ruslan was talking about, but deals are definitely taking longer. From the activity that we see around us, our clients and the business here, we've certainly seen an uptick in transactional activity over the course of August, and hopefully that will continue. And there certainly is still a lot of capital that's looking to deploy, subject to getting the right pricing on transactions, which I think will be the biggest challenge for the rest of this year and start of next year.
Yes, maybe if I can continue. So for the CE region and for offices in particular, only a few investors feel comfortable to take investment decisions at the moment. Those that are active expect COVID discounts in pricing today, and sellers are largely not willing to meet these discount demands. And that's why investment transactions are still simply delayed. And there are even some buyers who are demanding even up to 15 to 20% discounts, which are immediately rejected, and therefore there are no transactions at the moment. Usually what we have observed that transactions which were agreed pre-COVID and were closed just after COVID, there was like a last-minute pricing adjustments in the range of, let's say, 30 to 50 basis points higher investment yields. There is hardly any investment demand for retail, and logistics is again the most active sector. With in Poland, there was a record high investment volume last year of 7 billion, out of which 40% was allocated to logistics, and this year this percentage may grow all the way to 50%.
And a last interesting point I actually wanted to add to this discussion. I wanted to add one last point to this discussion. So when you look at at pricing of debt in this entire dynamic, actually base rates have gone down, spreads have gone up, and they reflect the risk profiles of the sectors, of course. But base rates have gone even further down. So actually, your financing costs have pretty much stayed flat on standard income producing assets, on the bread and butter of the market. And the shops are open. The market is very diversified with a lot of alternative lenders and private credit non-bank providers that basically are hungry for exposure, because real estate debt still prices a good premium over other private credit. So this flush of capital that we see sloshing around has led to actually wide availability of financing, even in a market like this. So we're not seeing any financing-led distress.
Mm-hmm. Yeah. Absolutely. And leverage levels are also lower than what we've seen during the GFC. So that's also a factor.
We certainly came into this market in a much better place from a financing perspective. So the CAS report shows that about 40% of debt was at less than 50% leverage. And as Ileana was saying, the diversity of lenders that we now have means even if some of the traditional lenders are a bit more muted in their appetite, there's a whole swathe of alternative debt providers that are keen to pick up financing transactions.
Absolutely. And we're almost out of time. I just wanted to ask one final wrapper question. So for all of the panelists to say in one sentence, what do you think is the greatest opportunity this pandemic could present for the real estate sector?
For me, it's really straightforward. Let me start. It's basically as simple as technology adoption acceleration and digital data accumulation. Those are the opportunities that we shouldn't see wasted through this crisis.
For me, I'm wearing my institutional hat on. for international investors, offices are really the place to be at the moment, to acquire at the moment, because of the price discovery and the slight discounts they can get on their main food group, and because in the end of the day, the pandemic will be resolved. It might take a year, it might take two, but the office sector has the best forecasts.
From a financing perspective, I'd say it's those lenders that can provide if sort of bridge financing or transitional financing that can help businesses to re-stabilize that maybe have had cash flow issues. So particularly in the hospitality sector, say, I think that's a really interesting space to be in at the moment.
Okay, and for me, I think it's definitely the logistics space. Even though it's correctly priced at the moment, I think offices are probably too risky at the moment, because even if you can extract like a 10% discount, that's actually not really clear whether it's actually the price is too high considering the long-term prospects of this sector.
Okay, fantastic. Well, it's been a very interesting and fruitful discussion. Thank you. And what we're going to do now is I'm just going to pass over to Fabio to say a few words about the INSEAD Community Impact Challenge. So Fabio, if you want to put your video on.
Thank you, Rika. And thanks for giving me the opportunity to talk very briefly about the Community Impact Challenge. So the Community Impact Challenge is an alumni-driven initiative that aims to basically mobilize the community with concrete action to create a positive impact on our daily lives. Impact, of course, aligned with the UN Development Goals. So what we intend to do is to raise awareness, educate, and trigger habit changes towards greater sustainability in our everyday life. And our history is pretty recent. We started earlier in 2020 with a single-use plastic challenge, as some of you might have participated. And now we're launching a second initiative, which is related to food. This initiative is starting on the 1st of November, will last until the 12th of December. Effectively, we are planning a number of events in collaboration with INSEAD, with the Hoffman Institute, and with the newly funded Community Impact Challenge Academy, providing webinars and contents and events around sustainability. The upcoming food challenge, which as I mentioned is running again from the 1st of November until the 12th of December, basically revolves around three main initiatives and ask you to pay attention to, number one, food type. So what type of food, of course, you are consuming, paying attention in particular to the origins of the food that we purchase on a daily basis, and looking for low carbon impact alternative. Number two is asking you to reduce meat and dairy consumption. As we know, these are amongst the highest CO2 producing food, and therefore trying to limit our consumption of meat and dairy has a positive impact. Also, I would add on our health and long-term being. And finally, on the food waste, so trying to control and reduce what comes into the house, but also what gets thrown out, of course, is very important. So, of course, if you're up for it, you should definitely join the challenge. This is a challenge that is not only for INSEAD alumni, but it's also for family, friends, and colleagues. So we welcome also non-INSEADers. You find a lot of information on this, and of course on other events on the Alumni Association, on our UK Alumni Association LinkedIn page. So please do go on our page, subscribe if you haven't done so, and you'll find all the links and additional information on this challenge and on future events of the association. Thanks again for the time, Rika, and over back to you for concluding remarks.
Okay, thank you very much for that. So yes, thank you everybody for joining. It's been a great discussion. If you do have any further questions, please do feel free to reach out to us directly and we'll get back to you. Thank you.
Thanks very much, everyone. Take care.